Here is one of the most comforting beliefs in any boardroom. The day federal regulators come knocking, your directors and officers' insurance policy will step in and protect you. I want to bust that belief today because it is a myth. A federal investigation is not the same thing as a covered claim. Those two things feel identical when you are the one being investigated. In the fine print, they can be worlds apart. So picture the moment. A letter arrives from a federal agency. It requests documents and it names your company. Your first instinct is to relax because you pay good money for executive protection. But here is the question almost nobody asks. Has anything actually triggered your policy yet? In a lot of standard policies, the honest answer is no. Not yet. And that one little word "yet" is exactly where the danger lives. Today, I will show you why an investigation and a covered claim are legally different, and how that gap can leave a whole board paying its own legal bills. Stay with me, because by the end you will know the exact language that decides whether your policy wakes up or keeps quietly sleeping. First, let us be clear about what directors and officers insurance is really for. Directors and officers insurance protects the people who run a company, the executives and the board members, when they are personally blamed for how they did their jobs. It is not property insurance, and it is not general liability insurance, which is the coverage that responds to things like a customer slipping in your lobby. It is also different from errors and omissions insurance, which responds to mistakes in the professional work you deliver to your clients. Directors and officers insurance sits above all of that. It is built to protect the personal assets of the decision makers themselves, the home, the savings, the retirement they spent a career building. But here is the part that trips people up. This coverage does not switch on just because you are worried or just because regulators have become interested in you. It switches on when there is a claim. And in insurance, the word claim has a very specific, very narrow meaning. A typical policy responds to a claim that alleges a wrongful act. A wrongful act is basically an accusation that a leader breached a duty or made an error while doing their role. So the whole machine is built on two words working together. A claim alleging a wrongful act. If both of those are not present, the policy can simply stay quiet. And that is exactly the crack a federal investigation can slip right through. So why is an investigation not automatically a claim? Think about what an early investigation actually is. An agency is asking questions. It wants documents. It is trying to find out whether anything went wrong at all. At that stage, nobody has formally accused a specific executive of a specific wrongful act. There is no lawsuit, and often no formal charge of any kind. And many older or narrower policies were written to respond to claims, not to questions. In those policies, an informal inquiry, a document request, or a routine audit may not fit the definition of a claim at all. The coverage can require something far more formal to trigger. Something like a subpoena, a formal order of investigation, or a written demand that names an insured person. So the boardroom feels like it is under attack, while the policy, calmly reading its own definitions, sees nothing that qualifies yet. This is the gap the industry quietly knows about. Newer policies have tried to close it, but they do not all close it the same way, and older ones may not close it at all. The wording is everything. Which means two companies can hold policies that look almost identical and get completely different answers the day an investigator finally calls. Let me walk you through how a good, careful executive gets blindsided. Imagine a mid-sized company. Well-run, profitable, nothing scandalous about it. One day, a federal agency opens a broad inquiry into the whole industry. The company gets swept into it. Investigators request years of emails, board minutes, and financial records. The board does the responsible thing. They hire experienced lawyers to respond carefully and to cooperate fully. Then the invoices start to arrive, because responding to a federal investigation is not a quick phone call. It is a marathon. There are document reviews, witness interviews, and depositions. This discovery phase can stretch across many months, and sometimes across several long, grinding years. So the board calls the insurer to open a claim. And this is the moment the myth quietly meets reality. If the policy only responds to a formal claim, and no formal claim has landed yet, the insurer may say the matter does not trigger coverage right now. The executives assumed they were covered from the very first letter. The policy may not agree until things get far more serious. And notice the cruel timing here. The costs are often highest early during discovery, which can be the exact window the policy treats as not yet a claim. So who actually pays during that gap? This is the part that really stings. In that window, the legal bills do not wait for anyone. Lawyers experienced in federal matters are expensive, and the meter runs from day one. Imagine defense costs climbing into the hundreds of thousands of dollars, purely to respond to questions, before anyone has been formally charged with a single thing. If the policy has not triggered, those bills can land directly on the individuals, or on the company, out of their own pockets. And there is a second sting hiding right underneath the first one. Directors and officers' coverage often has a part designed to protect individuals directly, so leaders are not left exposed when the company cannot, or will not, cover them. But if the investigation never crosses the line into a covered claim, even that protection can sit unused while the personal bills keep piling up. So a board can be technically insured and still personally out of pocket at the exact same time. That is the whole trap in one sentence. You are covered until you are not, and people often discover which one they are at the worst possible moment, long after the fees have already started running. Now let us look at the exact language that quietly decides all of this. Everything turns on one section of the policy, the definition of the word claim. That single paragraph decides whether an investigation counts. In some policies, the definition of a claim is written to include a formal investigation of an insured person. In other policies, it is not mentioned at all. Newer policies may add specific investigation coverage, sometimes for the costs of responding once a formal order or a subpoena actually arrives. But watch that word formal. It is doing an enormous amount of work in that sentence. Coverage that only begins at a formal order can still leave the earliest, informal stage uncovered. And the informal stage is often where a lot of the money is spent. Some policies go further and offer what is often called pre-claim inquiry coverage, which can reach earlier steps, like an interview request before any formal action. The difference between covered from the first letter and covered only after a formal order is not a small detail. It can be the entire ballgame. And none of this is one size fits all. Policy forms and state rules vary, and two carriers can define that very same word in very different ways. Which is why reading that one definition, before anything goes wrong, matters more than almost anything else in the whole document. So here is how to protect the boardroom before an investigation ever shows up at the door. Start with the definition of a claim in your own policy. Read it, and then ask one plain question. Does it include investigations of your executives? Then ask whether it covers only formal investigations, or also the earlier, informal inquiries and interview requests. Ask specifically about investigation costs and pre-claim inquiry costs. Find out the exact moment the coverage is designed to begin. Look closely at the protection built for individuals, the part that defends the leaders directly, and make sure it is strong and hard to erode. Ask how defense costs are handled. In particular, whether the insurer advances those costs as the bills come in, rather than only paying you back at the very end. Talk honestly about your industry. If your field tends to draw regular federal attention, that is a reason to take investigation coverage seriously, not a reason to assume you will be fine. And do all of this while the water is calm. Once a letter has arrived, you can rarely rewrite the policy that was supposed to cover that letter. None of these questions make you paranoid. They simply make you the kind of board that reads the fine print before it ever needs it, instead of during the crisis. Because the goal is simple. You want the policy to wake up on day one, not on the day a long case finally becomes a judgment. So let us bring it all home. A federal investigation and a covered claim can feel like the very same thing and still be legally quite different. Your directors and officers policy is built around a claim that alleges a wrongful act. If an early investigation does not meet that definition, the policy can stay asleep while your legal bills stay very much awake. Now the important part, and I mean this sincerely. Everything I just walked you through is educational, and it is not insurance advice. Policies and state rules vary, and only a licensed agent who reads your actual policy can tell you what you truly have and where your real gaps are. Please talk to one about your own coverage. If this cleared up something that has always quietly worried you, do me a favor and subscribe. We make commercial insurance make sense, one plain English episode at a time. I am Ray. I will see you in the next one.